Time flies, man. 2025 was nothing short of a roller coaster ride. Heck, we're just 6 months in and it felt like 6 years. And I'm not too sure if I'm alone on this. But anyway, if you take a look at the S&P 500 stock chart, I think you can basically categorize them into 3 distinct periods. The first part, which is at the start of the year until middle of February, basically the investment world was excited for the new man in town. Or if I can put it, the new man in the White House. So we have economists and investors talking about how Trump's deregulation and even tax cut policies, it's going to fuel the next bull leg of the US economy. And in the next period, from March to April, everybody was in for a rude surprise with Trump unraveling the entire global world order, talking about reciprocal tariffs, and a lot of these recessionary fears. And of course, in the third period, markets are basically shrugging off many of these tariff or recessionary fears. And it really felt like just yesterday where I posted a video talking about the idea of an impending stock recession and how I'm intending to take advantage of that drawdown. And as always, we have our naysayers. Don't pin your hope on a V-shaped recovery in stocks. It will be a prolonged one as the real test of US companies' earnings is not first quarters, but the next few quarters or years. We have yet to see the real impact of tariffs on US consumers. Tourism in US will soon be non-existent under Trump, and the USD is already tanking. A bad sign that global investors are losing faith in the USD as it becomes protectionist and moves away from the rule-based order. Have fun buying. And in fact, I do hope most of you did have some fun buying in the last 2 to 3 months. Now, as the market continues to record all-time highs, I do believe that the voices of investors in the both extreme ends will start to get louder. By definition, a contrarian investor is someone who deliberately decides to go against the prevailing wisdom of other investors. And with all-time high markets, clearly the skeptical bunch are the ones that are calling for the imminent collapse or the inevitable pullback or bear market. The fear and greed index currently pointing towards extreme greed, and the natural question would then be, is it finally time to be contrarian or to even bet against this upward momentum of the S&P 500? So before we go into those discussions, I think let's take a step back into understanding why would investors even be interested in the first place of trying to be a contrarian. And I think one of the best explanations around this concept of being contrarian is being put out by Howard Marks in his 2006 investment memo, Dare to be Great. And to summarize his entire thesis into one sentence, you can't just take the same actions as everyone else and expect to outperform. It basically underpins the idea of contrarian investing. You want or you are seeking for outsized returns. So if to look into this simple 2x2 framework, comparing conventional versus unconventional behavior and focusing on the conventional norm, aka following the herd, if you are met with favorable outcomes, you naturally get average good results. But on the flip side, if you are met with unfavorable outcomes, naturally it will result in average bad results. But if you to flip the script and to focus more on unconventional behavior, or in this case, the discussion of being contrarian, and if you do have what it takes and you are exposed to favorable outcomes, you then get above average results. But on that same note, if you are met with unfavorable outcomes, you'll get below average results. So by zeroing back into the idea of being a contrarian investor, all you are doing is just increasing the range of outcomes. But I think one of the key misunderstandings of being a contrarian investor is that not only do you have to be contrarian, and in fact, it is a prerequisite in order for you to achieve outsized return. The more important thing, or in fact, I would argue the most important thing, is actually being right. You have to be contrarian and you have to be right in order to achieve above average results. If you're contrarian but wrong, then all you can do is just suck it up, buttercup. And since we are already on this topic of contrarian investing, and we have agreed that it isn't just about being different for the sake of it, and it's really more so about making informed decisions that are right at the end of the day. And personally, I do rely heavily on Seeking Alpha's premium membership to deep dive into financial data and different market analysis, and more importantly, when I'm researching my own stocks. And currently, they're offering an exclusive deal that's going to expire on the 7th of July, which is in a few days' time, where you get to experience a 7-day free trial and get 20% off your annual subscription. So for myself, when I'm using Seeking Alpha's platform, let's say, for example, I'm currently researching the company Lululemon. All I have to do is to just type in the ticker symbol and I get instant access to 10 years of the financial data of the company. And I can manipulate the data however I want, whether is it to look at it from a trend analysis or to look at their past records on how they fare during bear markets or bad economic times. And in fact, Seeking Alpha has its own internal grading matrix that allow you to compare on a bird's eye view some of these different valuation matrix. And of course, the most important draw of Seeking Alpha, it's actually their community driven research piece. And just by reading a few of these articles, of course both bullish and bearish, gives you a very holistic view in terms of the investment thesis and opportunity today. And if you're interested in getting a 7-day free trial, the link will be in the description below. This video is not sponsored by Seeking Alpha. I just wanted to put the offer out there for those of you who are interested. Now let's get back to the main crux of the video and probably why you clicked in the first place. And of course, it's a midpoint update. So for those of you who are not aware, I actually do share my portfolio pretty transparently, and I'm basically building this portfolio alongside you guys while treating this YouTube channel as some sort of a video archive. So I've actually digged up the previous video that I've made in the mid of January at the start of the year, and just by doing a very quick comparison today as of where my portfolio currently stands, it's at roughly 225k in terms of market value. And I'm using this portfolio tracker platform called Potsedo. Huge shout out to them. I'm in love with this platform, and they actually do help investors do this sort of real-time comparison versus when if you're not investing, I would have only 184k, and what if I actually invested in the S&P 500 in that same cadence and time frame of how I put in the money, I would have 248k. So when comparing the portfolio performance versus some of these key benchmark indices, you can see that on a year-to-date basis, I'm clocking in roughly 10.5%. This portfolio has run for roughly 4.5 years. On an annualized basis, money-weighted return, I'm doing around 10% year on year. I think all things considered, it's not too bad, considering the fact that at the earlier part of my portfolio building journey, I was basically all into Chinese tech, and as we know, over the last 4 years, they have been underperforming by a very significant margin, and it's only just the last 1 to 2 years that they started catching up. So that's why you can see that on a 1-2 year time frame, I'm barely catching up with the S&P and QQQ, and it's really modeling very closely to the Hang Seng Index. And yeah, I think only over the last 1 year, the Hang Seng is outperforming all other benchmark indexes. But if you really take a much longer time frame, at least since the inception of this portfolio, which is at the end of 2020, I think annualized the S&P and QQQ, which is the NASDAQ, beat this portfolio hands down at roughly 15 to 20% annualized returns. But personally for myself, I think I'm still quite hopeful and optimistic in terms of the positioning of some of these very key or core holdings in the portfolio. But anyhow, I think just zooming into the trade analysis tab, if you compare the top line figures in terms of market value of 225 versus the 174k that we just started out with, that's a delta or difference of 51,000. Taking into consideration the buys and sells for 2025 alone, I bought a total of 68,000 worth of equities and sold roughly 32,000. So that's 36k in terms of additional capital that I've put into the portfolio for the first half of this year. But I think just putting the nominal figures aside, because it really doesn't mean much of whether I contribute 36k or 360,000. To each its own, and some people think it's a lot of money, while on the flip side, there are others that think it's peanuts. But the focus here really is just looking across the trends over the last 5 years. There is this consistent contribution and this focus on portfolio building. And it doesn't matter we are in a bull or bear market. And as you guys know, I think 2022 was the inflation bear. And over the years, there is just consistent contribution on my end on trying to build the portfolio bigger and hopefully stronger. And at least based on preliminary observation, I do favor bear markets a lot more, and I do contribute a lot more aggressively during sharp drawdowns. And to also give you some sort of a visual illustration of my buys and sells, the blue B bubble represents my buying transactions, while the grey S bubble represents my selling transactions. And I think thankfully, just looking at this broader picture without much context, I am taking advantage of many of these dips, and I'm listening to my own advice of buying in when there is more fear. And in all transparency, this is my current portfolio allocation. What's my average cost, my unrealized gains, and the market value, and how many shares I have in individual positions. So if you are really interested in my investment philosophy, I think you can just take a screenshot of this portfolio allocation, pump it into ChatGPT, and ask them to reverse engineer the investor mindset. But I think what I wanted to focus in this video specifically is the specific trades, buys and sells in the first half half of this year and my thinking process behind them, and to give you some sort of a real-time reflection as to why I made certain decisions. So I did track all these transactions in an Excel sheet, and what I did was to just copy those relevant ones, at least for 2025, and pump it to ChatGPT and ask them to aggregate the portfolio transactions for me. And I think just to share a few takeaways when I was preparing this presentation deck itself, and one of the more memorable ones was actually the transactions around Meta platforms, where I managed to sell at the previous peak and then buy back in during the Trump tariff commotion. And you might think that the learning lesson was that you might trim when you think that the price is overvalued and then buy back when it's undervalued. I think this is just one of the positive case study or example. And there are many other negative case studies where other investors share with me that whenever the share price sees some very strong appreciation, even though the business fundamentals are still improving and growing, they started to take some profits off the table, but the shares just keep going up. For myself, actually my learning lesson was not so much of that, but more so, actually because I sold 4 shares and I bought back 4 shares, I thought that, I was covered. But in fact, I think when I asked myself deep down, I wanted to increase my overall exposure to Meta and to buy even more shares. So that was some sort of you can call it limiting belief or a limiting frame of mind of thinking that, I just bought back 4 shares and it's good enough for me. But actually, no, I should not be anchored to my previous exposure. Instead, take a cold hard look at my portfolio and to manage the exposure from there and not so much being anchored by the previous number, rather than this idea of being able to sell high and then buy back at a lower price. To me, that's really just pure luck. And also, for those of you who have been following, I actually sold out my entire Adobe position with a very small profit, but the whole idea and concern around the business model today is really the penetration of AI. And in fact, another company that is also front and center around AI concerns is actually Google. So I've actually made the decision to just swap out Adobe and just used all the proceeds to buy back into Google, since both of them are having momentary concerns of AI, and I really don't have better, more differentiated insights into understanding which will win, but I do feel a lot more safer with my bet with Alphabet or Google in this case. Next up, of course, moving on to my largest exposure, which is towards the Hong Kong market, I've decided to sell out of my entire US Alibaba BABA position because I don't want to handle double counting, and then you have your dividend withholding tax, you have your ADR fees and stuff like that. So I've decided to just switch them all out. But in fact, actually 187 BABA shares actually represented closer to 1,005 or 1,006 9988 Hong Kong Alibaba shares. But I only bought back 800 because in the meantime, I've decided that my overall Alibaba position is a little bit too big. So I've reallocated to 0700, which is Tencent, and 3690, which is Meituan. But I think given the recent protracted downturn of Alibaba, I've decided to add 200 more 9988 shares. So it brings my total aggregated cost amount to be around $111 per share. And on another note, I've decided to cut out my entire Haidilao stake and reallocate it to Meituan. And for those of you who don't know, actually Meituan is a newly initiated position in 2025, and it has quickly succeeded into my 4th largest position currently. And if you to ask me for my justification, I think in my own personal view, I think Haidilao and Meituan is in some sort of an adjacent market where Meituan is more of a tech food delivery platform, but Haidilao is much more on the ground in the F&B retail industry. So both are probably kind of affected by very similar undercurrents, but might be of very different catalysts in this case. So for myself, I just decided to consolidate the position and I'm more comfortable with my Meituan exposure. So other than those mentioned, I think for the rest, so if you have your big tech and semiconductors like Amazon, ASML and Nvidia. And I think there is another segment that was punished quite badly in this whole Trump tariff story, which is in your luxury / consumer discretionary segment. So I've only added a bit in my Lululemon and LVMH exposure, but because in that time period, there is actually quite a lot of other stocks that I'm interested in buying as well. So that's why not a lot of love flowed to them. So just a few reflections in first half of 2025. I think within a few blinks of the eye, the US market is back to all-time highs again. And what's new really, especially for those investors in the last 5 years, you just buy the dip and you wake up after a few months and we are back to all-time highs again. So clearly you definitely have bubbles of commotions of people that are bearish and they will stay bearish, and vice versa, where you have the bulls calling for the next bull run. And so you have your perma bears and your perma bulls constantly tossing it out. So I did kind of notice the phenomenon. Many retail investors have been trained the muscle memory to just BTFD, which is buy the effing dip, since it always recovers quickly. And I intentionally use the first letter caps of always quickly, because there is this notion of thinking that if you just buy the S&P 500 or buy US stocks, they always recover, and you have this very strong and long history backing up your case, which I won't denounce that fact, but I think the second more important factor is this idea of quickly. Will they always recover quickly? That I'm not too sure. But I think for myself personally, I think there is always this lingering feeling at the back of my mind, looking at all these valuation metrics, looking at how the markets have performed. I might not be as bullish as the perma bulls, yet at the same time, I don't necessarily think that we are in a bubble of any sort. So I'm not calling for a crash, but I'm just kind of stuck in between. I also don't want to just look at the broad market and say that, oh, it's overvalued and there's no opportunities and I don't want to buy US equities and just check out. But I think the intuitive sense for seasoned investors is really the faster the price of valuations rise in the short term, the lower the future expected returns. And this is the law of investment gravity. Unless this very huge increase or expansion in price or price multiple is justified by a huge increase in the future productivity gains or EPS growth. If not, all you are doing is just robbing yourself of your future gains and just pulling it forward. And compared to just 3 months ago, I think there is indeed a sea change in sentiments and prevailing narratives of your tariffs, war, bond, rates, spending, US dominance, arguments, etc. So it's a huge testament of markets always climbing on a wall of worry. And also, not going to lie, as an active market participant that sat through the first half of 2025, I myself was personally also spooked out by some of these prevailing narratives. And also because of this backdrop and my preconceived assumption of them maybe going through a protracted downturn, I was ready to deploy more capital when it went lower. So I was not taking full advantage of this very quick V-shaped recovery. So I do get the sense that I'm falling into the same quote-unquote trap again, like back in 2021, where the US market just keeps pushing higher, while the Hong Kong market or the Chinese market is going the reverse way. Then in the 2022 bear market, it was also the first time I started monitoring the US market much more closely and started some positions from there. And with this new all-time high market, I am finding lesser opportunities in the US. I'm not saying there's no opportunities, but you need to try a lot harder. And I don't wish to keep concentrating into those underperformers over the last 4 years, which is in the Hong Kong market, considering that I've already built a pretty sizable position. And my current game plan, as the US market continues running up, is that I'll look towards buffing up my cash reserves and to not just deploy wherever, unless I think those value places, which is specifically the Hong Kong China market, becomes dirt cheap again, and not just in bargain territory, which is what we think they are right now. And lastly, I think I'm not going to give you any bold calls or predictions as to where the market will turn out in the short to medium term, because I believe most of you already have a baseline view yourself, and my answer here will not do you any good, because you either just agree and reinforce your existing beliefs or think that I'm just BSing and wouldn't listen to me anyway. So I've learned over the years, especially as an active investor, that there's no point spending too much time thinking about the macro and having a view of such things in the first place, of where the S&P will lead you in the end of the year or next year, what's your price target, so on and so forth, because it might even affect your judgment and decision making subconsciously. And the emphasis here should then be to focus on what you can control and let the rest take care of itself. And I think I'll just end off this entire discussion with this meme comparing the stock you sold versus the stock you're about to buy and your stocks in the first half of this year. And with that in mind, I'll see you in the next video, and more importantly and hopefully, I'll see you guys on the moon. Goodbye.